Let's check out the North American markets again. We saw stocks trading higher at the open. We are going to be hearing, though, from Jay Powell, the boss of the Fed, this week, that his speech at the Jackson Hole gathering of central bankers is expected on a Friday morning. Collective noun for central bankers, maybe a hedge or a fudge or vagueness. I always find them very hard to figure out their pronouncements. So there's market uncertainty, in particular, on whether interest rates will go on rising and at least how long they're going to stay high. Where can investors find opportunity? Let's bring in Ryan Belanger, founder and managing principal at Claro Advisors. Ryan, thanks very much for coming on the show.
Nice to be with you.
What about interest rates? Is that a thing you spend a lot of time on? And are they weighing on the market right now?
Definitely. We spend a lot of time looking at interest rates, because that really helps investors evaluate their opportunities. For years, interest rates were 0% after the great financial recession in 2008, 2009. So almost every opportunity from an investment standpoint looked better. But now, with interest rates at 5.25% to 5.5%, and perhaps going higher, investors have a real opportunity outside of the stock market, the bond market, and real estate. They can sit in cash. They can sit in a money market and earn a nice yield and wait for opportunities to come to them instead of chasing opportunities that might not pan out for them. So we think there's a lot of opportunity out there. But you have to be patient, and now you're getting paid to wait, which is great. So interest rates are very important, and I think all eyes will be on Chair Powell this week and what his remarks are.
You're cautious about the market. You think people should think long and hard before putting new money to work in stocks?
I think that's accurate for new money. I mean, I love the stock market. I think there's no better wealth creation on the planet than investing in American innovation and capitalism. And that's been proven out for 100 years. But for right now, for new money, if you have cash, I would be cautious. I'd be waiting for good opportunities. There's signs out there, and there's definite warning signs that we don't want to ignore. There's plenty of bright spots in the economy, but fiscally, we have a spending problem. We owe a lot of money and interest to a lot of people, and that's only going to get worse, unfortunately. And then I just think there's opportunities, within the market that people can look at that, would prove to be good long-term strategies, but you have to get in at the right time. And so I think we really encourage people to stay patient, know what they own in their portfolios. And it's okay right now to sit around with new money and sit in cash and wait for those opportunities to come. Because I think there's data that will come out soon that'll show that, we're going to be slowing down. Historically, when the 2-year Treasury rate and the 10-year Treasury rate go negative, we get a recession within about a year and a half. And that happened last summer. So we're kind of any day now for the recession, we feel like, although the market's been very resilient this year and people have been rewarded to stay invested, we think now might be a good opportunity to rebalance your accounts.
When you say go negative, you mean when the short-term interest rate's higher than the 10-year bond yield?
That's exactly right. It's called an inverted yield curve.
Sure.
So that happened last summer, and it's been inverted for quite some time. And so even though the long end has picked up a little bit recently, it's still inverted, and that's a big warning sign to investors that a recession might be on the way. In addition to most of the leading economic indicators have all been flashing warning signs for months, and so the consumer has really stayed resilient. I mean, people are continuing to buy goods and services at these elevated prices, which has helped the market and has really buoyed the market in a lot of ways. But how long can that last? And so we're going to find out in the coming months if the consumer is still willing to pay up for these goods and services.
The 10-year bond yield in America, about 4.3%. Do you see it going, or there's a case to be made that it goes to 5%?
I think so. I mean, it's kind of simple math. You take the you take the nominal rate. There's a little bit of a premium. There's the neutral rate. You add those all up, and you kind of get to where you should be. I think if rates continue to go up, my feeling is we'll get one more rate increase. It might not be in September, but we might have one final increase. And then I think we're going to hold steady there for a while. I mean, Chair Powell does not want to repeat the mistakes of the 1970s. And so I think he's been steadfast, and he'll be diligent, and he'll make sure he keeps rates higher for longer. And I think ultimately that'll probably, tip us into a recession. But we won't have a lost decade, which is what we had in the 70s. So I think it'd be wise to stay higher for longer and wait this out.
And you mean the mistake they made in the 70s was not taking inflation seriously enough?
Well, I think they took it seriously, but I think they thought the fire was out when it was still smoldering a little bit, and then inflation jumped back up to 10% in the mid 70s, and then they had to repeat the cycle again. And so you got to make sure the fire's out before you start cutting rates. And I think a lot of people had forecasted, even the Fed, that they might be cutting rates right about now a year ago, and obviously that isn't happening. And predicting these things is very difficult. It's hard to be critical of people who are making the forecast, but if you just think logically, these things take a lot of time to play out. So you've got to just take a much more longer termed approach to your forecast. And so we believe at some point the recession will come. It doesn't have to be terrible. These recessions can be mild. We've got a really strong labor economy, and a lot of good things going for the country. People owe much less debt than they used to. They have more equity in their houses. But recession is just part of the economic cycle. And I think as investors, you just have to be prepared for that and know what you own in your portfolios. Make sure you're rebalancing, and don't just put your head in the sand. That's the worst thing you can do.